Hello, everyone. Today is Friday, October 21st, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 654, presented by The Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets. These videos are broken up into two parts. In part one, we look at everything that went on this week in markets. We go through the numbers and pick apart the moves that stand out or look different, interesting, or notable. And then in part two, we jump into the charts. We take a detailed, close look at price action and those market trends and try and best position ourselves looking ahead. So hopefully that sounds good. Let's jump into some of the headlines from this week. First and foremost, option expiration. That's what we just went through this Friday. Had a bundle of options. I don't know what the actual stat was on what the notional was expiring this week, but there were a lot on the table. And notably, it was a green Friday. That is notable because the last dozen or so Fridays have been red and have been deeply red. In most cases are 1.5% to 2% down very consistently over the past month or two. And this Friday, we finally finished strong, held on to some weekly gains and finished green. Now, we also have earnings season, which is officially underway. We had a busy week this week, but next week is where we get the big influential sort of FANG names and some of those very large mega cap companies that are going to be reporting earnings, giving guidance, and really giving the market some indication as to how bad the environment is out there. The earnings season this far has been, generally speaking, it's been fairly lousy numbers, but the reactions have been sort of decent. So that basically would suggest that the market has done a good job at sort of pricing in a relatively, uninspiring earnings season so far. I think we are running some down, negative numbers. I was looking at them earlier. I don't have them in front of me, but uninspiring numbers, but the market has been kind of hanging in there, generally speaking. So we care about the reaction, and so far the reaction has been pretty decent. Credit markets this week, though, that was the big story. They are totally broken. We saw some real acceleration to the downside in already, sort of prolonged downtrends and oversold conditions. We really just got some very historic kind of capitulative moves. If it were a traditional stock market, I think that's how we'd be thinking about it. But because these are credit markets, because these are U.S. government treasuries, it's just a different situation in terms of the illiquidity and sort of seizing up of these markets. We're going to talk more about that in part two. I do think this is an important week to listen to price action. There's a lot of noise out there, and this week is telling some pretty interesting stories. We're going to talk about that in part two. And then we had the largest down week in the dollar for months. And so that's certainly helping paving the way to this market rally. All right, let's get into the numbers here. Green across the board. Look at these pretty healthy, strong green numbers here. 4 to 5% basically in all the U.S. indices. The Nasdaq 100 was the best outperformer this week here, but notice on the 1 month numbers, it is still the laggard here on a relative basis. Now, if we take a look at market trends here, we are starting to finally peak up and, unanimously sort of find some rising 10-period simple moving averages. So we're just looking at market trends across the 10, the 50, and the 200-day moving averages. And you can finally see we got short-term trends up, medium-term trends down, long-term trends down. So that gives us a little bit of kind of the cross currents and mixed picture that we're seeing out here, at least in the short to medium term. If we look at the volatility environment, we did see that unwind a little bit. So essentially across the board here in the S&P, the Nasdaq, and the Russell, we did see the volatility unwinding a little bit, which is good to see because, again, as we've been kind of harping on here, we want to get the VIX back under 30. That is where we can finally start to, at least put in or think about the easier sort of long exposure and trying to get the market to get off the edge of a cliff. And because we are going in on a weekend here, VIX down around 30 with a busy earnings week ahead. Do think that was encouraging, but there's still plenty of room to the downside here that we'd want to see the VIX, tackle lower. So good, kind of consistent move. Stocks are up. volatility coming out. That is what you would expect, and that's what we got this week. Now, in terms of breadth here, looking at 52-week highs and lows, this is still pretty uninspiring in terms of the bull case. We are getting, some pretty nominal numbers here in terms of stocks hitting 52-week highs. I mean, basically 40 and 50 each and every single day this week for a total of 198. But if we look at the lows, we're in triple digits all week long, and we got 1,284 aggregate or cumulative lows made this week. So this is still heading in the wrong direction. We need to see the number of stocks hitting 52-week highs start to expand. We want an uptick in those highs. We want the lows to start to dry up. That is going to give us more confidence that institutional money and stocks and breadth are all supporting the move higher. We're not there yet, so we're going to keep to measuring this until we are. If we look at sector performance, it was green across the board this week. So every single sector was in the red here. Energy was the standout winner again. And then take a look at the 1 month numbers now for energy, up 23%, basically more than almost every single other sector combined. Energy is just really kind of moving up. Technology, interesting to see finally kind of, springboarding higher here pretty aggressively. It was up 6.46%. Materials was up 6%. On the downside, it was the boring stuff. It was utilities, consumer staples, and healthcare. This is your classic sort of risk on dynamic or picture here, where you have tech and basically cyclicals here leading to the upside, defensive stuff on the downside. Now, if we take a look at IBD's industry ranking here, so this is a snapshot from their digital subscription. They are a sponsor of the show and our content at large here, so we want to thank IBD for that. You can support the show, you can support them by subscribing with our partner link here. But basically what we're looking at here is a snapshot of the industry rankings, and you can see that it's still very dominated by oil and gas, so there hasn't been a whole lot of change in here, except for this number 9 spot is interesting, and I'm not even 100% sure what this is. Electrical contract manufacturing, perhaps. So you can see here that this is really kind of stepping up here from weeks ago. It was much lower in the ranks, and you're seeing some acceleration here to just general top relative strength composite rating. So that is notable. Everything else here has stayed pretty consistent with just oil and gas dominated. Now, if we look at 10-day correlations, we continue to see pretty much the same. I mean, last week we did note that some of these correlations between the indices were starting to break down just marginally, and it's kind of the same situation here. For instance, the Dow Jones to the Nasdaq is running at a 0.64 correlation. Again, doesn't seem like a whole lot, but we've been in the 0.9s for basically 3, 4, 5 months straight, so we're starting to see just a little bit of decoupling here, which is a net good thing in my opinion for markets for stock pickers to basically dictate where money should actually be flowing rather than just risk on, risk off. Otherwise, everything else in here is pretty much, dollar inverse correlation is still just super strong, and we continue to see that. Now, if we look at treasury yields, again, this is the pain point here for the markets. And I got to say, I mean, given what the 10-year yield did this week, getting up to 4.2, in fact, it was even higher than that before it started to pull back a little bit. But, given what happened here in credit land and interest rates, just broadly speaking, it is very surprising, let's say, to see the divergence between equities and what credit markets are doing here. It feels like one has to be right, the other one is wrong, but so far we're waiting to see which one blinks first here. Do we get just a super, free fall here in yields next week, or do we see equity markets come crashing down to sort of, get back more in alignment? That's, what we're going to be looking at in part 2 here when we start to break down some of this price action. If we take a look at dollar and commodities here, so basically we had silver at the top of the list, 5.65% leading the charge, followed by copper and gold. Crude oil was pretty flat this week, held in there, but not too much. Everything else here was negative. Natural gas was just really falling like a rock this week, 20%, just some extreme volatility out there in UNG. We say it over and over again. This is just such a beast to trade here. Natural gas, it's just got so much gap risk and volatility. And today, or this week at least, shows that picture. Take a look at the dollar index right down here as well, 1.15%. That's one of the worst weeks in months. And that's what supported, certainly equity markets, as we saw with the inverse correlation, and helped, bounce some of these other commodities. Bitcoin very flat this week, trading much like a stable coin recently. So if we take a look lastly at our trading system positioning here, we've got our Merlin trading system, which is just very mildly involved in this market, and mildly is sort of an overstatement. It's just 2% equity exposure, 98% cash. So it is just not really doing a whole lot, not budging too much. Our short-term trading system is short the market right here. So actually at a 25% short exposure here. So it is very much, pessimistic on this market or taking advantage of this bounce. It's still got plenty of cash. It's not a big, bold bet, but it is leaning on the short side. And our trade risk index is basically the combination of these two. It's 11% short right now. So very defensive and very sort of kind of risk off right now as we just experienced a big up week. It's ironic because my personal conviction here lies a little more optimistic in the short term. And we're going to talk about that in part 2 here in just a second. So we do have trials available. We've got a lot of information, literature about these trading systems, including performance on our website. So check out the 14-day trial. Check out some of that education we have on our website. You can find it there in the top right of your screen. Now, that is it. We're going to move on to some charts here. So if you do want to continue on, if you want to catch the full version here, if you're not already at thetraderisk.com/SMW, well, that's where you can go. You can purchase the full-length episode here for $5 if you just want to continue on and get our part 2 version. We're going to go on for another 10-15 minutes. Or you can subscribe and save $15 a month, gets you access to all of our long-form content, analysis, and ideas coming at you once a week every Friday. So if you want to continue on, there's the link. And with that, hopefully you had a good week trading out there. Have a great weekend ahead, and we'll see you back here, as always, every Friday after the market close for our Stock Market Weekly. Take care.